Today, we sit down with Michael Blanc, and Michael shares why today is actually a great time to be investing in real estate, despite what you hear from others in the market. So listen, Michael is the CEO of Nighthawk Equity. He is the host of the Financial Freedom Through Real Estate Investing podcast, and he shares why market sentiment is actually wrong, and not just wrong now, but always wrong. So if you want to learn why he's a firm believer that now is the right time to be investing and why you should be greedy while others are fearful, you want to make sure you check out today's conversation right here on Multifamily Insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide, go to our website, casmoncapital.com/7 questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Now, Michael Blanc is a real estate investor, best-selling author of Financial Freedom with Real Estate Investing. He's a speaker and the leading authority on apartment investing. Now, as the CEO of Nighthawk Equity, host of the Financial Freedom with Real Estate Investing podcast, and columnist, Michael is passionate about helping people become financially free by investing in apartment building deals and raising money. Let's welcome to the show, Michael Blanc.
What's going on, John?
Hey, what's going on, Michael? Hey, we had you on the show a couple of times, so it's exciting to bring you back on and to hear what you've been up to. And we'll link to our previous episodes with you in the show notes. But for those who are not familiar with your story, why don't you take 2 minutes and fill in some of those gaps?
Yeah, I have a background maybe that a lot of people can maybe resonate with. I was taught to go to school, get good grades, get a job with benefits, and that's what I did. And I joined a software company in the late 90s, and that was significant because I was one of the very early employees there, and that company went public in March of 2000. At the time, it was like the biggest software IPO like in history. And the day later, the NASDAQ literally crashed, like the bubble popped. And so we were all gazillionaires on paper, and then by the time the lockup ended, we were only millionaires, which is not a bad place to be. And so I coasted along, kind of grew bored a little bit, and then read Rich Dad Poor Dad in 2004 and really threw me for a loop, so much so that I quit my job. And I learned and studied how money works. And I traded some stocks and options for a while. I took a real estate investing boot camp. And my big idea, though, was to get into the restaurant business, a franchise specifically. And it worked great for, year and a half or so until the recession hit. But I went all in. I went this is it. This was my ticket to permanent financial freedom. And it did not turn out to be. Instead, it was a complete and utter loss of capital because the recession just decimated this particular concept and I had no way out. And I lost all of my money and added a couple $100,000 in debt on top of that. And then tried to dig myself out of it with real estate. In 2006, I flipped a couple houses, got into the restaurants. And I remember that was actually pretty good. It was actually fairly profitable. So I decided to kind of go all in flipping houses. So I'm flipping houses. And I'm running these restaurants, trying to eventually sell them, which took way longer than I thought it would. So I'm working 65 hours a week, and I'm losing money on the restaurants, making chunks of money on the house flips, and it was an entrepreneurial freaking nightmare, is what it was. So I was like, man, I wish I had my job now at this point. And then in 2011, I kind of accidentally got into a apartment with one of my wholesalers, bought it with a 12-unit in Washington D.C. And I remember my commercial real estate stuff, dusted it off. And with some effort, had 5 investors and we bought this deal. It was a Section 8 DC in Washington, DC, and it was a disaster. I should never bought in DC. I had the wrong property manager and I immediately regretted that thing. But when it finally quieted down after a year and a half, which was a long time, it just started sending me this mailbox money. And that's when finally the light bulb went off. If you really want financial freedom with real estate, you cannot be flipping houses. You can't be building a rental portfolio. It takes too long. It's not scalable. It's too much work. And so I try to figure out how to get myself more into this apartment building kind of world and started blogging about it. How I find this deal? How did I raise the money? Blog for Bigger Pockets, created an analyzer, created a course. And now deals started coming my way. And so, today we have $300 million in multifamily real estate. We also have a coaching platform with a mission to help people become financially free with real estate, but maybe not in the way that they think right now, which is typically through single family house investing strategy.
Michael, I appreciate you sharing that journey. Even though I'm pretty familiar with it and I've heard it a couple of times, listen to your podcast, there are some nuggets that I didn't even know, and I want to play back some of this, right? So a lot of this is familiar, right? You were working in corporate America, working for, a tech firm, had a big IPO, made a lot of money. That a lot of money on paper or tied up in equity wasn't quite as much once you were actually able to access it. But you started to invest in different things. You had a little bit of real estate, doing some stocks. You ended up buying these restaurant franchises, and the economy just completely tanked. And that ultimately ended up derailing where you were financially. So these investments aren't really working. The flips were working. So you started to do more of that. And eventually you get into commercial real estate with this 12-unit apartment deal in DC. And that actually wasn't working out of the gate, right? You said it was a disaster. And it took about a year and a half before it ultimately turned around, started generating some passive income, and you recognize this was the path forward. Today, you and your partners have over $300 million worth of apartments. You have an education platform. You help other people as well. I want to rewind the clock back, right? Because you talked about the restaurant franchises. You invested in this. This was kind of the vision, and you kind of got derailed. And what I heard you talk about were at least two different times in your story, and probably about three other times from now and going back to 2000, where the economy took a dive and it impacted your ability to generate profits, right? First of all, with the dot-com burst, second time, obviously, when the economy crashed. How do you look at that, right? Because right now, as we're talking, there's a whole lot of conversation about a recession, and interest rates are high and inflation is there. And, the economy is not what it was just a couple of years ago. So as you play back on your journey to present day, how have you pivoted your investing strategy, recognizing the impact that market conditions can have and the things that you can't control?
Yeah, let's talk about a risk-adjusted return. I think we can spend the rest of this episode talking about a risk-adjusted return. We're always looking for a return. What most people don't realize is at what potential risk that you can get that return. And so I did not even think about it. Like, I had giant happy ears on when I got into the restaurant business. And I know this because I personally signed on leases, which kicked me in the butt when things went bad. And luckily, I only had one lawsuit getting out of these leases, but they're all personally guaranteed, which means that if something goes bad, whatever it is, and you owe a bunch of money, which let's say you sign a 10-year lease and you get out of it in year 3, you owe 7 years of rent on that, and the landlord will sue you for the remaining term on the lease. And even if you have an LLC, it doesn't matter because you personally signed a loan, which is one reason I like investing in commercial real estate. The loan balance typically is above $1 million. It's what's called non-recourse, meaning that if things go bad, they can't go after your personal assets. And in this case, it was all personally guaranteed. I didn't realize the risks, and there's with anything we do, there's operational risk and there's a market risk, right? For operational risk, which I didn't occur, it was set up, done as a passive investment, right? So I'm the money guy. And so I signed these franchise agreements, and then I hire a guy to run them all. He was an experienced multi-unit restaurateur, and he was great. Except then, and so that was great. That the operational risk is that he is not great, or he quits his job, and now one would have to find this replacement. This takes time and training, and so who's going to be running the business while that person is not there? Well, it'll be you. Therefore, it's no longer really a very passive investment. And this, by the way, applies to other cool strategies like buying a business. Buying a business, people don't think about the operational risk. You buy this business, it's super cool. But if whoever's running it is no longer there, who's going to be running it? Well, it's going to be you for a time period, right? Do you want that? Now, to me, that's not very passive. With multifamily, I have dozens of potential professional property managers I can choose from. So if one doesn't work out, I can just call the next one. They're already trained as handling the keys. And there's a transition period, but I'm not like training them or hiring them necessarily. So there's operational risk, which I didn't think about. It didn't occur to me per se. Mine was more market risk, right? So whatever your investment, whatever vehicle you have that gets some kind of return, what is the market risk? And I didn't realize that a high-end pizza concept would be very susceptible to some kind of market correction. But a lot of people aren't aware of the potential risk. Whatever strategy you're doing, we're always trying to figure out how to make money. And in this case, real estate, but how risky really is that thing, right? So single family houses, a lot of people are doing rentals and whatever. 2008 should have been a wake-up call. Most people have forgotten what happened in 2008, but that asset class is very susceptible to market conditions. So I have less control over them, like I with commercial real estate. I'm almost 100% reliant on whatever's going on in the market. Market's going up, good for me. Market's going down, there's not much I can do. And so in that case, I know people who spent 5-7 years building substantial single family house rental portfolio, and they lost everything. Like, to me, I want some kind of vehicle that gives me runway. Decades, potentially, right? I can work on it for 10 or 20 years, give it to my kids, they can work on it. And to me, single family houses, because of that one thing, really was a wake-up call for me and many others. Like, my gosh, maybe this isn't the best vehicle to build wealth with. And so to me, looking at the risk-adjusted return is very, very important. Even though when you're looking at multifamily deals, people are always comparing the returns. Okay, but that's not right, because I can make my spreadsheet say anything I want. I can put a 20% IRR in there, but what are the assumptions behind it? What is the risk behind it? And so as an investor, if you're looking at the fundamentals, you really have to consider the risk. Or either if you're an active investor, what's the risk of what I'm doing? Also, how passive is it? We can talk about that as well. And if I'm a passive investor, not just what are the returns, but what is the risk underlying those returns?
Yeah, those excellent information, man. You talked about understanding the risk-adjusted returns, first of all, from an operational standpoint, then from the market standpoint. And the truth is, there are certain things we can control and things we can't control. We can control the operations to a certain degree. You can't make someone not quit, right? I mean, obviously, if that manager quits, he quits. But you can have a plan in place for what happens if that were to take place. From the market, you really can't control that. So you have to figure out what is your strategy, and are you somewhat insulated from things you can't control? And that's what you get with commercial real estate. And obviously, you and I are both multifamily guys, but this is true for a lot of commercial real estate, which is one of the appeals. You talked about, again, with single family, when the market goes down, not a whole lot you can do, right? You're pretty much restrained by whatever your neighbor sells their house for, whatever the market conditions are today. In commercial, you do have a little bit more control. Can you just clarify how you have more control and maybe some of the things you can do if the market goes down in commercial property?
Yeah, so single family house, right? You have two houses next to each other, look identical. One is a rental property. Let's call it a rental property, and you can even call it an STR if you want. Though there's some lenders now who are lending on the cash flow. But let's say it was 5 years ago. So you have an STR making $1,000 a month, and then you have a primary residence that's producing no income whatsoever. They will be valued the same, right? Someone looking at houses is going to go, I'm going to pay the same for that and that. It doesn't really matter what the underlying income is. But commercial real estate, it's valued almost entirely on its NOI, its operating income, the income. So I can have two identical boxes that look exactly the same. Well, one's producing more income than the other. The one's producing more income is now worth more. Now, this is important because I can now execute what's called a value add strategy. I can go in there and let's say I have a nice looking box with high income and I have a not so good looking box with lower income. And I can make the not so good looking box look like the other box and increase the income. And therefore, as I do that, raise the value of that box to the one that looks nice and shiny and has higher rents. And so now this allows me to what's called force appreciation. I don't need the market to go up. I can actually do stuff to make that thing be more valuable. Now, I can do the same thing with single family houses flips specifically, even the Burr method so all things being equal, I can actually raise the value of that as well. So that is the same thing. I can actually raise it, but the numbers are vastly different. I can on a flip maybe increase the value by $75,000, which is really, really cool. But a very small increase in rent, $50 a month, across whatever 50, 100 units is in the hundreds of thousands, if not millions of dollars in value. So while you can do both, it's not nearly as interesting to apply that strategy to a Burr method, for example, than you are to commercial real estate.
Yeah, I mean, and that's the thing that makes commercial real estate so appealing for people, right? It's understanding the dynamics. You mentioned kind of even in the housing game, if you're looking at STRs, which are short-term rentals, so think of your Airbnb investments, right? So even if you're using that strategy, some lenders will give you credit for the income, many will not. So you're still kind of, limited to what the market is, your neighbors are selling it for. But in commercial, you have the ability to force appreciation, right? You can go ahead and make renovations, make improvements, push rents, but it's more about the numbers. It's not about, some pretty cabinets or cool appliances. It just comes down to the numbers. Can you drive up that net operating income? And that's going to really be the telltale sign of whether or not you can create value. Now, yeah, go ahead, Michael.
Before we move on, John, the thing that's important from an investor standpoint is that you can invest in essentially a business plan, right? Because it's so deterministic. As an investor, I'm not just going in and hoping for the market to go up. There's a very distinct plan that I'm investing. I'm investing in an undervalued property because it hasn't been renovated in 25 years and the rents are clearly under market at the comps. So now I'm going to execute this particular plan. I'm going to turn 5 units a month, right? And so as an investor, the question I always ask is does the plan make sense, right? So the thing is, I can invest with an operator who has a clear, distinct plan to raise value. Whether the market goes up or down, it doesn't really matter. If it goes up, super awesome. If it stays the same, doesn't matter, right? Even if it goes down slightly, as long as the underwriting is in place. So what I'm saying is that the benefit of this asset class is that you have a clear business plan. As long as you can execute on it and the market doesn't come off its wheels, you have now a clear business plan, and that gives the investors confidence that the returns hopefully will become realized because it makes sense to them, and there's a clear plan to get there.
Yeah, let's dive into that more, right? So we actually put together a download. It's a guide. It's 7 questions you must ask before investing in apartments. We'll link to that in the show notes. But, we know the market has shifted over the last couple of years. And part of the reason it's shifted is what you're getting at. People went into these deals with certain assumptions. Those assumptions proved not to be true. And now some of these deals are struggling and not doing well. Can you talk about maybe some lessons learned over the last couple of years and how it informs the way you invest today?
In general, the risk profile today is vastly different than 2.5 years ago. And investors have to understand that while the asset class might be multifamily or self, whatever the asset class is, within that asset class, the risk profile is completely different. Now, so let me still listen. So within the commercial real estate spectrum, there's several that are more recession resistant than others. Self-storage being one, mobile homes being the other, and then multifamily being the third. The other ones are much more susceptible to a market like office, retail, things of that nature. So the reason that I say multifamily is the least risky of them is evidenced by the kind of loan you get from multifamily. And by the way, even compared to self-storage and mobile home parks, the interest rate is much lower and the leverage you get is much higher out of all three of them. So therefore, lenders must think that multifamily is the least risky, which is true for the most part. So, but the risk profile 2.5 years ago was completely different. So rewind the clock 2.5 years ago, we were getting extraordinary high leverage and the market outlook was actually negative. So very high leverage and interest rates, everybody agreed was going up. So it's not really a great time to invest, right? Super high leverage, risky, and the market outlook is not so good, right? Interest rates go up, cost of capital goes up. Obviously, what's going to happen to cap rates? They're going to go up and prices are going to go down, right? So prices are going down because of the interest rate outlook. And so that was 2.5 years ago. Now it's completely different. Now the leverage you get is very low compared to 2.5 years ago, and the interest rate outlook is flat to down. So it's totally different. So the risk profile is much. So now what's happening is we can buy stuff with lower risk because the leverage is lower and the outlook is better. Right? Interest rates are flat to down, and also the prices are now sort of like 30% down from where they were 2.5 years ago. So you're really able to get into commercial real estate at a discount with a very positive market outlook on the interest rates, and the long-term demand for multifamily is so good because you can't build affordable housing anymore. It's impossible because of the cost of capital, now the tariffs and immigration stuff. Permits are down like over 50%, if not more, over the last 18 months because of that. So there's no solution in sight to solve the affordable housing problem, which means that rents are going to go up because there's finite amount of affordable housing, and there's nothing coming behind it. So it's very important to understand that the risk profile 2.5 years ago was much higher than it is now. The problem now is, and again, this was a problem 2.5 years ago, everybody was frothy. Everybody was getting in the market at basically the wrong time. And now no one wants to get in the market at basically probably the most ideal time in recent history.
Yeah, and that's the challenge, right? And we believe the same thing, right? I think this is an awesome opportunity to buy. We're seeing deals that pencil for the first time in a few years. where we're excited. We're seeing deal flows. Brokers are calling us now and following up with us to say, hey, did you get a chance to take a look at that deal? That did not happen 2 years ago, right? You had
Oh,
a chance and you had to jump on it. If you didn't jump on it, by the time you called, they already had 4 offers and, we're going to best and final. And that's not the case. And the thing here is that there's a pendulum and it comes down to investor sentiment. And as you talked about it, when you look back a couple of years ago, the market outlook was actually not very good for the reasons you laid out. Today, the market outlook is positive, but investors, they kind of focus on the present. So the investor sentiment has soured because they're looking at deals that maybe aren't penciling, or again, the economy is going down, companies are laying off employees. So they're looking at all of this, the noise about the tariffs, right? They're looking at all of this and it's making them fearful. And it goes back to that very famous Warren Buffett quote: as an investor, you want to be greedy when others are fearful and fearful when others are greedy. And all of this from an investor sentiment is telling us that it's actually a great time to buy, but it's hard to reconcile that, particularly when you're a newer investor. It's hard to reconcile that with the noise you're hearing in the marketplace. What advice would you give someone, especially when they're starting out, when they hear you and I say this, but their gut and the news and everything they're reading tells them something else?
You have to strive towards becoming a sophisticated investor. And I say that because sophisticated investors like Warren Buffett are behaving differently because they're more sophisticated. They ask more questions. They study it a little bit more. They look beyond what's in the news, right? Because news is, first of all, hype, and it's delayed, right? Yep. It doesn't really give you doesn't really tell you what's going on. So become more sophisticated in your investing. And so this just simply means that you have to study the material a little bit more, ask more questions, and really see what's going on. Market sentiment is always wrong for the reasons we mentioned. It was wrong 2.5 years ago, and it's wrong now, right? We have our larger investors, for a time period, no one was investing in multifamily, right? It was like there's blood in the streets and like, oh my gosh, so bad. And that includes many of our investors as well. They're like, oh, this is bad. Like, I'm going to hold off and see what happens. But then what's happening is the larger ones are now coming back. Why? Why are they coming back? Because they recognized what happened. They understand exactly what happened, what the issues were, and they look forward and go, the likelihood of that happening again is not very high. They're constantly reassessing risk. Now, the reason that we couldn't foretell this risk is no one could forecast this. Okay, so even the sophisticated investors couldn't forecast. And I have proof of this because we got $40+ million loans 2.5, 3 years ago, and all we had to do was buy a $40,000 rate cap, for example. So that shows to me that even the very, very sophisticated lenders couldn't forecast this. Everybody forecasts higher interest rates. What they did not forecast, not even close, is forecasting 11 straight interest rate hikes. That no one had that in their crystal ball. So these sophisticated investors are constantly reassessing risk. And it is a bit surprising that they invested the way they did alongside everybody else because it was so frothy. But now they're starting to come back, and it's because they're more sophisticated. They're looking at this data, what's happening right now. They're looking at the leverage much, much lower. What I mean by that is, 2.5 years ago, you got 80% loan to cost, meaning that not just the purchase price, your closing cost, and for good measure, your construction cost. That's a lot of leverage. Right now, you're getting 75% of loan to value, just the purchase price. You're not financing any closing costs. You're not financing construction. So comparatively speaking, you're getting very, very low leverage, very low risk. They're also looking at the interest rate outlook. They're seeing and they're looking at the long-term demand for multifamily housing specifically. They put it all together and like, oh my gosh, less risk, interest rate outlook, relative positive, or at least stable. And the long-term outlook in multifamily is very good. There's no solution in place to solve this affordable, which is bad for America, by the way, but it's good if you're owning rental property in general. And they're putting all this stuff together and going, interesting. Interesting. I think from a real estate perspective, this is probably the way to invest. If I want real estate in my portfolio, probably now is as good time as ever, if not better, to invest. And that's so the call really is to study some of this data. Don't take our word for it, or maybe use it as a cue, but then research it. Research the interest rate outlook. Research the leverage. Research the outlook for the affordable housing problem and the rent projections, and then make up your own mind and see, hey, this is actually true. Does it sound like it might be a good time to get into it?
No, Michael, great stuff. And I love the way you talked about understanding the investor sentiment. I wrote down that quote, market sentiment is always wrong. And that's right? Because people get emotional and they're going off of what they see and they're not really taking that 2, 3, 4 year outlook of what's coming down the pipeline. So it's always going to be off, right? But really great intel on how to think about it and how to position yourself to take advantage of what's going on, not just today, but in the near future in the market. Hey, I want to transition just a little bit, right? Because you and I we both work with other investors, raise capital for our deals. We connect and spend a lot of time, podcasting and things like that to reach and connect with other investors. But I know it's gotten harder, right? Because of the sentiment we just talked about. What are some of the things you're doing to kind of pivot and adjust and how you're reaching and how you're connecting with investors?
It's a lot about education, kind of like we're doing here right now. Why is it a really good time to get into this business? How is it different than 2.5 years ago when some investors got burned? What are the differences? How can you recognize the difference? So it's a lot about education, frankly. And so that's what we're doing. We're doing it, both active and passive investors is explaining what's going on right in the market, what has happened, and what we think is likely to happen based on various data that's, readily available. So it's all about education, right? Because there's still a lot of fear out there. And this is the problem is because of fear, there's actually opportunity. Like you said, we're actually getting deal flow and we're buying basically at a discount with a good market outlook. And people need to know about that. But you have to overcome that fear. So the only way to do that is just to keep saying the same thing over and over again with basically data, backing up the data so you're not making stuff up. So that's kind of been our approach.
Yeah, that education is absolutely key. And, there's so many ways to do that. But ultimately, this is it's a long play, right? You're trying to get to know people. You're trying to educate them. I used to work in marketing and I was frustrated early in my career because I worked in automobiles. And I would tell the guys like, well, it's hard to figure out what's working because no one sees a TV ad and then decides to run out and buy a car, right? Or you don't, drive past the dealership and just decide, oh, you know what, today seems like a good day to buy a car, right? There's a whole buildup, there's a process, there's research, there's a lot that goes into it. But when you're buying a candy bar, it can be that quickly, right? You see an ad, the next time you're in a convenience store, or the grocery store or gas station, you see it, you might want to try it and you buy it right then and there. So it's easier to track what's working, what's not working. With the automobiles, I can never really figure it out. So we had a bunch of stuff. We know some stuff worked. We know some stuff probably didn't work, but we really couldn't attribute what was working. I feel somewhat similar when it comes to what we do in the multifamily space, right? Because we talk to people, we go to events, we, have podcasts, you do your email marketing and social media. And there's a lot of stuff that you do to try to connect with investors. But I know one of the challenges that people have is figuring out, well, what actually works and how do I educate people and how do I figure out what I should be doing to build these relationships? For those folks, kind of what advice or feedback would you give them?
Yeah, I mean, so you're talking about active investors who are trying to educate their passive investors a little bit more.
Yes, sir.
It really comes down to putting out relevant content. So what I mean by relevant content is the kind of content that actually helps people make a better, more informed decision, and ideally someone that would then invest with them, right? So these are more like mindset things and things like data. I mean, investors just really need data, right? So that's really my advice is putting out content that highlights some of the things that are going on, maybe commenting on, ad articles in the Wall Street Journal. Hey, look, this is ad that came out. Here's what's behind that, right? And just kind of tying it together like that. And it's just it is a bit of a long game at the moment, but again, we're seeing a lot of investors coming around to that, right? But you're not getting it from the news, even though recently there was a Wall Street Journal article about a private equity company. It wasn't Blackstone, it was another one. Literally, deploying. They just raised $2 billion for their real estate fund, and 80% of that is going to multifamily, right? So it's already starting to shift a little bit. You just got to stick with it, but you also do need a process. So it's not just putting out content. You need a bit of a process because you need to be able to connect with investors, right? So the ability to book a call with you to have conversations, things of that nature, an email address where people connect and ask questions with you. So you need a mechanism to actually connect with people versus just putting stuff on social media, right? Or on YouTube, where you don't really know who's watching it. It's super cool, but really what you need to do is you need to try to connect with them and get their email address. Now you can send them an email newsletter, perhaps. You can schedule a call with them, things of that nature. So putting out relevant content, but also then encouraging a conversation with you, I think, or getting on a webinar. Another great thing to do is to put together informational webinars with a market outlook, for example, and you need emails for that. right? So yes, you can put it on social media, but you don't really control that as much. So anything that you can get to build a connection and trust, it's a trust thing. It's not just multifamily that you need to overcome, but it's also why you, right? Why are you a good operator to invest with versus some other ones that might be out there?
Michael, I love it. And speaking of that, how can folks get in touch with you if they want to learn more?
Yeah, we're at thefreedompodcast.com. That's a website for our podcast as well. And it's thefreedompodcast.com/John. And it's to us, for our listeners, a great next step for people who are evaluating multifamily. We have a mini course called Apartments 101 that it's an hour-long video that introduces people to syndications if you're an active investor. Also, we have a mini course there for passives that explains syndications, what a real estate syndication is. And there's also a way for people to book a call with us as well on that. So it's thefreedompodcast.com/John.
So you heard it right there. Check out Michael at thefreedompodcast.com/John. And he laid out how to connect with investors and gave you a tool to do that for himself and his team as well. So make sure you check him out there. Right now, we're going to transition to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmoncapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmoncapital.com and click on the mastermind button today. Give me a failure or an apparent failure that sets you up for later success.
Yeah, we had a deal. We used to have a process where our students could bring us deals. This was many years ago, called the Deal Desk, and it was pretty cool for a while. And one of the deals we got was from our now current partner, right? Garrett Lynch, who's the co-host of our podcast as well. He brought us an awful deal in West Virginia. We passed on it.
To be clear, you
said
awful?
Awful. Yeah.
Okay.
Yeah. Then he brought us another deal, and this one was not awful, but it was a big one. It was an El Paso deal, and this was like 6 years ago, or I don't know, even longer. Time flies. And it was not only was it too big, it had hair on it. It was like a portfolio with some loan assumption. And we're like, oh, we can't raise it all ourselves, so we get all these partners in there, and people all passed on it. And it was like too complicated. So Garrett just worked this thing like an animal for like 9 months, got in like institutional investors, all for naught. We ended up losing our deposit on this deal. It's like that only deal that we lost money on was this one deal. And so that thing turned into a positive because Drew and I, my second partner, we got to get to know Garrett and how he works. And then we're like, this guy's an animal. We want him on our team. Even though it did not work out well, he's now our third party in Nighthawk Equity. So that's an example. And I think a lot of these examples where you had a quote failure is really a learning experience or some kind of experience that makes you a better person. You learn a lot more through your challenges or quote failures than you do your future successes. And that was certainly one of them.
I appreciate that. Shout out to Garrett. He's been a guest on the show and I actually just saw him a couple months ago. Good dude. All right. Give me a digital or mobile resource you recommend for our listeners.
Digital or mobile resource? Oh my gosh. Shucks. I don't even think about it so more. I use so many of them. Digital mobile resource. Something that's going to be less obvious. How about, Boomerang. Boomerang on Gmail. People don't know. So you're sending an email and you don't get a response. You send like dozens of emails per day and you don't get a response in a reasonable time period. How do you know you didn't get a response? So Boomerang sets a timer. If you don't get a response in whatever time frame you want, 1 day, 2 days, week, month, whatever, it just restarts it in your inbox and then you can follow up. So I use that for short-term follow-ups and long-term follow-ups. So not a big deal, but it just came to me, maybe less obvious. Well, there's so many things out there. We use that one of them.
Boomerang it is. Give me the book you've recommended or gifted the most in the last year, besides your own.
Besides my own, I probably I talk about The Miracle Morning a lot because it's been so helpful to me. But Hal Elrod, who's the author, actually has another book that's maybe less well known, and that is called The Miracle Equation. And the reason I like it is because it redefines goal setting. So goal setting is normally SMART goals that have a timeline and a deadline and is very measurable, that kind of stuff. And he kind of removes the timeline from it. So the problem is, like, for example, I'm going to do my first multifamily deal in the next whatever year. Well, okay, what happens if you don't? Right? Now you're discouraged and you might just go away because you didn't get your deal done in 12 months. You're a loser, a failure, and this whole thing doesn't work for you. What Hal says, instead of doing that, the problem with that goal is actually you don't control a lot of the variables that go into it. You don't control the seller, the broker, your investors, the markets, the blah, 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 a variety of things. But what Hal says, the thing you do control is the activity that leads to the outcome. So instead of putting a SMART goal, I'm going to do my first deals, commit to the activities and do those activities for long as it takes. So those activities is, basically finding deals, so underwriting deals, making offers, and talking to investors. If you do those two things, inevitably, you will get the outcome. Whether it takes 9 months or 18 months, it doesn't really matter. So commit to the activity that leads to your desired outcome, and don't necessarily put a deadline on that large goal that you have.
Give me a daily habit that helps you stay focused on your goals.
Yeah, I'd say the morning routine. Probably morning routine is probably one of them, but also time batch things. So I block out time in the morning. On 4 out of 5 days, I have 2.5 hours where I'm not doing any podcasts or emails or anything like that. And that's where I do deep work. All the other stuff is going to be meetings, emails, that kind of stuff. The kind of stuff that you kind of feel like is not really moving you forward as much. So I do that a lot. And then I do quarterly planning and monthly planning and also weekly planning. Normally I identify the 3 things I want to get done this week, and I look at them every single day and make sure that I'm spending what I call my strategic time, making progress on those three goals.
Give me your number one insight for investing, leveraging your risk-adjusted returns.
Biggest insight as an active or passive or what?
Let me ask it differently, because I think I want to take a slightly different direction. Give me your number one insight for identifying your risk-adjusted returns, either as an active or a passive investor.
Yeah, so I can go either way on this because it kind of simple. So if we're talking about multifamily, for example, I want to look and see the assumptions in the underwriting, right? So, and how conservative are those? In other words, you can't be too conservative, because if you're too conservative, you'll never get a deal done. But sometimes, if you look at some of these OMs, not these syndication packages, the assumptions are just very aggressive, right? So if rent growth is basically projected to be flat in a lot of MSAs right now, then why am I seeing a 5% increase in rent, right? Why am I seeing a 10% occupancy if you intend to do a heavy value add, right? If you do a heavy value add, that means you're basically doing a lot of renovation, and most likely your occupancy is going to go down for a little while as you're trying to turn units. So why does your occupancy, when it's currently at 10%, why is it still 10% 12 months from now? Doesn't make sense, right? So how many reserves are you having at closing? Are you taking reserves out of your cash flow to replenish those reserves, right? Because for example, if you don't take reserves out of your cash flow, my cash flow is bigger. My NOI is now higher, and therefore I can pay more for it. But it's much more risky. So I'm looking at the assumptions, and you don't have to be so sophisticated as an investor to know exactly what you're looking for. You have to ask the right questions. Does it make sense to you? Right? A business, a professional knows that if you don't have cash reserves, that's bad. Right? They know that they can ask certain questions, and does it make sense to them? Are there multiple margins for error built into it? And so that's what we're looking for in underwriting as well. We are no longer in the risk avoidance business. We're in the risk management business as an entrepreneur, right? So what are we doing? Do we recognize the risk, and what are we doing to mitigate those risks? And we do it with various points in our underwriting.
I love it. Great stuff there. Let's lighten the mood, man. Where are you at right now?
I'm at about an hour west in Atlanta.
Okay, so an hour in Atlanta. So let's just say, Atlanta market, Atlanta MSA. Give us your favorite place to grab a bite to eat.
Oh my gosh, I'm an hour west, which means I'm actually in the country. I don't spend that much time in Atlanta, honestly. We moved here about 4.5 years ago from Northern Virginia, and we're now on 30 acres. We have a pond, and there's a river that goes by, and a pool. And my neighbor has 225 acres and 82 heads of cattle. So we're actually a little bit in the country, and there's a whole bunch of little restaurants in this town that we like. And so my favorite food though is sushi. Probably number one is probably sushi. And so that's what I would say. I'm not in Atlanta too much.
All right. All right. There you go. So you're getting sushi, some sushi spots out there an hour west of Atlanta is what you're tracking down. So
There you go.
Michael, really enjoyed our conversation. You talked about a few things. One, your journey into entrepreneurship, going from being in the tech firm, working into the restaurant business, having your restaurant franchises, getting into real estate, recognizing that, there's something with this commercial real estate thing and really building out your multifamily apartment portfolio. From there, really teach other folks how to do the same, but also scaling that and talking about the importance of risk adjusted returns, right? Understanding that there's always going to be risk. You're not in the risk avoidance business, you're in the risk mitigation business, and understanding how to adjust and how to identify that. And the big thing was just understanding these assumptions. What assumptions are going into the deal? What can you control? What can you not control? And I love the quote you gave us earlier about the market is always wrong, right? When it comes to market sentiment is always wrong. But you really have to just understand what's really happening in the market and making sure we're making our best educated guesses of what we're going to do investing wise. For those folks who want to learn more, again, they can check out your website, thefreedompodcast.com/John, and connect with Michael and his team there. Michael, thanks again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.